The last couple of weeks have been a little confusing for all markets, except the bond market has taken a little bit of extra maybe flack for what's going on. Are the fundamentals really what's driving the market? Is it still monetary policy at a time when central banks around the world are kind of diverging in their strategies, yet we're kind of getting the all clear sign from inflation? And then there's the question of plumbing when it comes to the bond market as well. This is why I am not a strategist on Wall Street. It's because of a chart like this. For a radio audience, stick with me here. Basically, we're looking at 2-year and 10-year net non-commercial positioning, and basically it's a chart that goes all the way back to 2001. And what you need to know is basically you are starting to see short positions at their, lowest on record, basically. It really shows the fact that, maybe people are positioning for some sort of pop in yields. At the same time, if you look at the long end of the curve, people were the most long. It's a really kind of dynamic market where you really see both the bulls and the bears when it comes to the bond market kind of dig in. And this is why you bring in an expert like Bloomberg macro strategist Simon White, for example, to explain what is going on. So Simon, what's going on here?
Yeah, I mean, it's a conundrum, as you say. Bonds are very tricky. But what I think you've got to keep in mind for the moment is that any kind of rally, any sort of shorter term looking for lower yields, I think is a trade. I think the investment is for higher yields because we're in a different regime now. And I think the most important thing is inflation. So no matter really how you slice it and dice it, people talk about Fitch's downgrade, which is about fiscal deficit. People talk about the supply from the Treasury. These really are just reinterpretations of an inflation issue, right? If you have the government is issuing more debt, that's ultimately inflationary. You know, if you have higher fiscal deficits, that leads to a weaker dollar over like 18, 24 months. These are all inflationary signs. So the real change here is the fact that we're in an inflationary regime. And that really biases yields to be higher, not lower. So right now, bonds are fairly oversold. So we can see, I can see certainly in a shorter term, you can see some sort of reversal. They're also oversold versus stock. So I could see some reversal in the stock versus bond ratio. But really, any kind of rally in bonds, I think more is a shorter term thing.